What you're looking at right now is the complete SPX session from May 19th, 2026. But before we break down today's trades, I want you to pay close attention to what happens exactly at the 9:30 a.m. RTH session market open, the instant the opening bell hits. And at the 9:30 session open, the SPX daily key levels indicator maps out the entire battlefield for the day: R1 through R6 resistance, S1 through S6 support, the bull bear key price level, the bull bear line for the current session that defines directional control, YDH, YDL, and YDC levels, the previous day's SPX regular trading session, high, low, and close, PML and PMH, the SPX pre-market low and pre-market high. And even though the SPX index itself does not trade in the pre-market, the SPX daily key levels indicator is able to determine the SPX pre-market high and low through analysis of S&P 500 futures. Every major price zone is calculated and plotted automatically in real time the moment the market opens at 9:30 a.m. Eastern New York time. No manual drawing, no waiting, no guessing where price may react. And on that same first tick of the 9:30 a.m. market open, the indicator also identifies the day's market structure scenario. Today for May 19th, 2026, the market structure scenario is Market Scenario 1, inside yesterday's range. That one classification immediately tells you the type of price behavior, volatility, and reactions to expect throughout the session. The indicator's built-in market scenario analysis table gives you the key trading characteristics and dominant tendencies of the current session's SPX market structure scenario, along with what to typically expect in the session under this market structure. In addition to the comprehensive user manual included with the SPX indicator, you also get access to our one-page PDF cheat sheets for each of the 6 SPX market structure scenarios that you can download to your computer and also print out for easy reference. The PDF cheat sheets give you the key trading characteristics and dominant tendencies of each of the 6 SPX market structure scenarios, along with what to typically expect in each session for each market structure. This also gives you an easy reference outside of having the analysis table on your chart if you prefer to look at it on either a separate monitor or simply print them out for viewing, as opposed to having the market scenario analysis table directly on your chart. Now, combine all that with the day trading GPS ribbon tool. The ribbon gives you real-time confirmation of direction, momentum, and market structure, helping you identify when price is ready to react at those freshly plotted key levels. Together, these two indicators produce 3 high-probability SPX trade setups during the May 19th, 2026 trading session. Every entry came from either a candle close above or a candle close below a key level. Every bullish or bearish entry required confirmation from the ribbon tool. Every target came directly from a key level. And every trade followed a repeatable rules-based framework. These two indicators work in conjunction together to provide a defined system of structured, repeatable bullish and bearish trade setups in SPX. In this video, we are going to walk you through all 3 trades for today's session step by step. The entries, the confirmations, the stop-loss levels, and target levels for adjustments and exits, along with exactly why each setup triggered in real time. If you trade SPX, especially SPX 0DTE options or 1DTE options, this may completely change how you look at intraday trading. Let's get into it.
Okay, so now we're going to go through the 3 trades of this session and show you how the entries are confirmed, as well as the target exits and the stop losses used on each trade. So we're going to start off with trade 1 here, which is a bearish trade taken off of the 9:30 a.m. opening candle close. This candle closes below the bull bear key price level. So this is giving us the bearish entry alert here on the 9:30 a.m. opening candle, closing below the bull bear key price level, otherwise also known as the BBKPL level. Now this alert will only show up if the close of the candle is within the acceptable range for a trade off of the bull bear key price level on the 9:30 a.m. opening candle. If the candle closes above the bull bear key price level, then instead you would see a green alert label, and that green alert label would be below the candle in question. In this case, the candle closes below, so we're getting the bearish alert on the 9:30 a.m. Candle close. Now we just don't go off of the candle close by itself. The candle closing below the bull bear key price level is a bearish entry alert. However, we're also requiring confirmation from the ribbon indicator. And in this case, we have confirmation from the ribbon indicator because the ribbon is all red. The ribbon is not multicolored, nor is the ribbon green. So we're looking for the ribbon on a bearish entry on a close below a key level to be all red, not multicolored, not partially green and partially red, but it has to be all red. Ideally, we're looking for the lower part of the bearish red ribbon, for the lower part to be pulling away, or the lower bands pulling away from the base of the ribbon, which that is the case in this particular instance. So we're getting confirmation from the ribbon indicator on this close below the bull bear key price level. And so our entry is on the close of this candle on the 9:30 a.m. opening candle. We're on a 2-minute chart. The recommended chart time frames for this indicator and for this daily key levels trading strategy are between 1 minute and 5 minute. So if you prefer a different time frame, such as the 1 minute, 3 minute, or 5 minute, that's fine as well. Just know that the 2-minute is the recommended chart time frame between 1 minute and 5 minute, as we have found this to be the most consistent time frame within the 1 minute to 5 minute range. In any case, whether you're using a 1 minute, 2 minute, 3 minute, or 5 minute chart time frame, the candle will still need to be a close below a main key level or a contextual key level for at least the beginning part of an entry, and it needs to be confirmed by the ribbon as well. So regardless of the chart time frame you're using, you're still going to use not only the close above or below a main key level or main contextual key level, but you're also needing that confirmation from the ribbon, which in the case of a bearish entry needs to be an all red ribbon, not multicolored, and ideally you're looking for the lower part of the bearish red ribbon, the lower bands, to be pulling away from the base. On a bullish trade, you're looking for the exact opposite. You're looking for a close above a main key level or a contextual level. And in addition to that, you're looking for not only the candle close to be above a main key level or contextual level, but you're also looking for the ribbon to be all green, and for the ribbon, the top part of the ribbon to be starting to pull away from the base of the ribbon, such as the case here. And we will look at this trade later on in this session, but just wanted to explain the difference between bullish and bearish confirmations for right now. Now on this particular trade, you have two different stop losses that you can choose from when utilizing this indicator. Either a tight stop loss or a standard stop loss. The standard stop loss is the recommended stop loss to use, as that is why it is called the standard. For those that prefer a tight stop loss, the tight stop loss is going to be on a bearish trade, the QL above the particular level that you're taking the trade from. So in the case of a bearish trade from the bull bear key price level, it's the QL above the BBKPL level. If you were taking a bearish trade, say off the R1 level, then you would simply turn on the QL level above R1, and that would be your tight stop loss for a bearish trade off of R1. On a bullish trade, such as the case here off of S1, if you wanted to use a tight stop loss, then you would use the QL level below S1. Now the standard stop loss is going to be your midpoint level. In the case of a bearish trade, it's going to be the first midpoint level above the level that you're taking the trade from. In the case of a bearish trade from the bull bear key price level, it's going to be the first midpoint above that level, which is this level here, mid BBKPL R1. If, for example, you had a bearish trade off of R1, then you would simply turn on mid R1, R2, and use that as your standard stop loss on a bearish trade from R1. For example, for a bullish trade off of S1, whereas the tight stop loss was the QL below S1, the standard stop loss is the first midpoint below S1 on a bullish trade from S1, and that is mid S1, S2. As you can see here on this trade went all the way down to S1 before retracing back up after hitting the YDL level, and it retraced back up, and it did actually hit the tight stop loss. So if you were using the tight stop loss on this trade, then you would have gotten stopped out. However, you did have an opportunity to exit the trade here, either at the PML level or the S1 level. With this particular indicator, you have two different types of trades that you can do. One is a scalp trade, and the other is called a regular day trade. With a scalp trade, you're looking for a one level move in your favor for an 100% exit or an adjustment on the trade. With a micro scalp, you're looking for a contextual level that happens to occur prior to the one level move in your favor, as long as it is far enough away from the initial entry point. In this case, the PML level fits that, and so if you were doing a micro scalp, then on a hit of the PML level, then that could be considered a micro scalp exit. However, a full regular scalp trade is a one level move in your favor, and that is calculated from the level that you're basing the trade on, the direction of the trade, and one full key level away, which in this case is the S1 level. A regular trade differs from a scalp trade in the required move in your favor that is required as the minimum threshold for either a 100% exit or an adjustment on the trade. So for a regular day trade, there are two different levels that you can choose from. Either a 1.5 level minimum required move or a 2 level minimum ideal move. The reason why there's a difference between these two is the 2 level minimum ideal move is called the minimum ideal move because in 80 to 85% of the sessions that you will see in a normal year in a normal trading environment, in a normal volatility environment with SPX, a 2 level extension away, up and down from the bull bear KPL is going to be the range in 80 to 85% of the sessions that you will see in a normal year in a normal volatility environment. So a 2 level move away from the bull bear KPL above or a 2 level move below constitutes the entire range that you will normally see in 80 to 85% of the sessions. In the remaining 15 to 20% of the sessions throughout a normal year with a normal volatility environment, you will see that the remaining 15 to 20% is comprised of a couple of different volatility structures. Part of that will be lower volatility mean reverting sessions in which you will see very choppy environments in which price will struggle to and will be confined either within the mid BBKPL-R1 down to mid BBKPL-S1 in extreme low volatility environments, or R1 down to S1 in normal lower volatility environments. Then the balance of those 15 to 20% of sessions will see sessions that go above R3 all the way to R6 or below S3 all the way to S6. So the range can be from R6 down to S6 in those higher to extreme volatility days, whereas in the lower choppy environments that comprise those 15 to 20% of sessions, it will be anywhere from the midpoints or from R1 down to S1. But in 80 to 85% of the sessions, R2 down to S2 will comprise 80 to 85% of the sessions in a normal year in a normal volatility environment. A 1.5 level and 2 level move is calculated as follows. You look at the level that the trade is based on, in this case the bull bear key price level. You look in the direction of the trade and you go 1.5 levels down in the direction of the trade. One level is the S1, 1.5 levels is mid S1, S2, 2 levels is the S2 level on this bearish trade. On this particular trade at 10:06 a.m., the mid S1, S2 level was hit here. Our entry was on the 9:30 a.m. candle. On the close of the candle, as you can see here, the ask price 27.70 on the close of this candle. On the close of the 10:06 a.m. candle, after it hits the mid S1, S2 level, you can see here the bid is now $34.60 on the close of this candle. So the difference between those two is the profit if you exited 100% at this 1.5 level move in your favor. The 2 level minimum ideal move was hit at 10:20 when it hit the S2 level here on this particular candle. As you can see here, this candle touched and then backed off, whereas this candle touched and then moved through it. So basing your adjustments or your exits on the close of the candle sometimes will work out in your favor, as in the case here, and sometimes it will work out not to your favor, as in the case here where it's slightly backed off. The main thing that you want to keep in mind on exits or adjustments when it hits a certain level, either on a scalp trade or a regular trade, is that you need to use the same system each time. So if you're going to go on candle closes, you need to go on candle closes after it hits the level. Or if you prefer just to close out or adjust when it actually hits the actual level on the hit, then do that every time. The main thing is just to be consistent in how you approach it each different time so you have a repetitive system that is easy for you to follow. Now on here on the 10:20 a.m. S2 level hit, which is the minimum ideal move, as you can see here, now the bid is $43.60. So your profit is the difference between the cost here on the ask at $27.70 and the bid here at $43.60 on this candle close. And as we mentioned earlier, a two-level move is generally going to be the extent of moves that you see in 80 to 85% of the sessions in normal years and normal volatility environments. However, if you want to stay in the trade after the hit of the 1.5 level or 2-level move in your favor, then the most prudent thing to do is to use the option of closing out 60 to 90% of your option contracts when it either hits the 1.5 level or 2-level move in your favor, and then adjusting your stop loss on the remaining runner contracts to break even, which would be the price that you paid for the option, or break even plus a 10 to 15% profit buffer. That way you've extracted the majority of the profit from either somewhere between 60 to 90% of your original position, and then you just have a remaining minor part of your original position in which you've adjusted the stop loss to break even, the price that you paid when your entry was executed, or uh, break even plus an additional profit buffer. Then at that point, if price does happen to continue to move in your favor past a two-level move in your favor, then you can continue to either adjust your stop loss by adding on additional profit buffers at each additional key level move in your favor, which would be either additional midpoints, additional key levels, or additional contextual levels, which happen to occur after either the 1.5 level move or 2-level move in your favor. In this case, in this particular trade, all of the contextual levels do not occur after the 1.5 level move. So you would just be dealing with either mid S2, S3 next, and then S3 below that, and then mid S3, S4, and then S4, etc. However, in this case, as you can see here, price did not move down further and began to turn around. So that is another reason why this is a demonstration of one of the typical sessions in which you will see in 80 to 85% of the sessions in a normal year and a normal volatility environment, where a two-level move below or two-level move above away from the bull bear KPL, with the entire range being R2 down to S2 in 85% of the sessions. One thing to keep in mind with your stop loss adjustment is that when you start your trade, you are using levels as your initial stop loss on your entry. However, if you end up doing an adjustment to your trade, you are then switching to the price that you paid for the option and adjusting it to break even, which would be the exact price you paid, or break even plus an initial profit buffer. On the initial entry, you're either using the standard stop loss, as we talked about, or the tight stop loss. Now we'll move on to trade number 2. Okay, so now we're going to look at trade number 2. Trade number 2 is a bullish trade that occurs on the 12:24 p.m. candle close above the S1 level. As you can see here, it also closed above the PML level. You could either use the PML level or the S1 level on this trade as the basis for the trade. If you use one of the contextual levels, then you simply go into the user control panel to either select the tight stop loss or standard stop loss for trades for contextual levels. We're not going to go into that in this particular video. If you'd like to see more details about how to utilize the indicator and the full daily key levels trading strategy and the other features of the indicator, simply go to the description of this video and click on one of the other longer SPX session videos or the features and setup video that is found also in the description of this video. Click on one of those links and it will take you to either longer SPX session videos, which will go into more detail about this indicator and the daily key level strategy, as well as the lotto option strategy that is also available to use. And you can also look at the other link, which is for the features and setup video for the SPX daily key level 3 V3.0 indicator. And that particular video is split up into chapters, so you can simply go to the feature that you're looking at, which you can look at the stop loss levels for the contextual levels and how to do that with the indicator. In this particular video, we're just going to go over the 3 trades of this session because we're trying to make it a shorter video. If you are interested in learning more details about how this indicator works and the daily key level strategy in more detail, simply click on one of the links to the longer SPX session videos found in the description of this video. Okay, so on this candle close here, we have a candle close above a main key level, the S1 level. Your tight stop loss here would be the QL level below the S1 level. Your standard stop loss is the first midpoint level below the level that we're basing the bullish trade on, in this case the S1 level, that is the mid S1, S2 level. As you can see here in this particular trade, neither stop loss was hit in this particular trade. Now as far as option strikes, again, there are 3 different option strikes that you can utilize. However, in this particular video, we're just going to go over the standard play, which is the at the money strike, which is the strike closest to the level in question that you're basing the trade on. In this case, 73.5712, so that's going to be the 73.55 call option. Remember that you can use either 0 DTE or 1 DTE options, as all of your trades are going to be opened and closed during the same session. So you don't want to use anything that's more than 1 DTE, because anything above that, you're simply paying for time value that's not going to be of any consequence because we're just opening and closing trades all within the same session. We're not holding any trades overnight or holding it over from session to session. Okay, so in this particular case, the close on this candle, the ask price is $17.60. Now that's per call option. So if you're doing multiple call options, then you would just simply multiply that times the amount of options that you're using. So one call option is going to cost you $1,760. If you were using 10, then that would cost you 10 times that, $17,600. If you were using 3 options, then it would be 3 times that, 1,760 times 3. Okay, so in this particular case, here are the stop losses. We have confirmation from the ribbon because the ribbon is all green on the close above this key level. And the top part of the all green ribbon, the top part is pulling away from the base. So that is the ideal bullish confirmation for this close above this S1 level. If we were doing a scalp trade, our exit or adjustment would come at the bull bear key price level, as that is the one level away, one full key level away in the direction of the trade, calculated from the S1 level. The 1.5 level is going to be this mid BBK PLR1, and the 2 level minimum ideal move is going to be the R1 level, as that is 2 full levels away. In this case, there is no micro scalp opportunity because there is no contextual level that happens to occur before the bull bear key price level before the 1 level move. So in this particular case, there is no micro scalp opportunity and you only have the regular scalp opportunity after the 1 level move. In this case, at 1:04 p.m., It does hit the mid BBKPLR1, and that is the 1.5 level minimum required move for a regular trade for either exit or adjustment to the trade. At the time it hits that, on the close of the candle, the bid is $32.90. So your profit is the difference between the $17.60 and the $32.90. Now on the 1:20 p.m. candle here, we have a hit of the R1 level. That is now your 2-level move from S1 to R1, the minimum ideal move for the regular trade. On the hit of that level, on the close of the candle, the bid is now $39.40. Now we'll move on to trade number 3. Okay, so now we'll look at trade number 3. Trade number 3 is a bearish trade, which occurs on the 2:50 p.m. candle close below the BBKPL level and is also confirmed by the bearish ribbon. 2:50 p.m. entry on candle close below BBKPL, which occurs here. As you can see on this candle here, we have an all red ribbon and we have a close below the bull bear key price level. Our stop losses are going to be the same as the first trade because they're still based on the bull bear key price level. So our tight stop loss is going to be the QL above the BBKPL on this bearish trade from the bull bear key price level. Our standard stop loss is going to be the first midpoint above. So these stop losses are the same as the opening candle trade in which we saw again the 9:30 a.m. candle also closing below the bull bear key price level. In this case, though, neither stop loss was hit, neither the tight stop loss or the standard stop loss. One thing to keep in mind is that this trade is occurring at 2:50 p.m. So in this case, since the trade is occurring with just over an hour left in the session, you have to be very cognizant about your exits. So when a trade is developing this late in the session, you want to be more concerned about monetizing your trade at the first possible instance, because time is running out as the SPX index closes at 4 p.m. In this case, the S1 level was hit for a regular scalp trade, a 1-level move in your favor on the 3:44 p.m. candle here. As you can see, this took basically about 54 minutes to develop from 2:50 p.m. down to 3:44 p.m. So again, now time is running out in the session. You did have an opportunity here, if you wanted to do a microscalp, to get out at the PML level. Because remember, a microscalp is an alternative scalp if a contextual level happens to occur prior to the 1-level move in your favor. We did not have that opportunity here on the second trade, as there was no contextual level that happened to occur before the 1-level move from that bullish trade. However, in this case, you do have that opportunity here that occurred on this candle, which was approximately 20 minutes prior to this hit here. So if you wanted to get out on the PML level on the microscalp, then your exit would have been here. However, here is the S1 hit for a regular scalp, which does occur at 3:44 p.m. And at this time, the bid is $18.60. So your profit is the difference between the entry of $8.20 and the bid of $18.60. Now the trade does end up hitting the mid S1, S2 level before the end of the session here at the 3:52 p.m. candle close here. As you can see, it hits the mid S1, S2. However, the prudent thing to do here is to simply exit the trade here if you were having multiple contracts and wanted to adjust to see if you could get a further down close in your favor before the close of the session. Then you would want to be very cognizant about adding an additional profit buffer then that is more than the profit buffer than you would do normally. So you would close out 60 to 90% here, and then on the remaining runners, instead of adding the typical 10 to 15% profit buffer, you would want to add a lot more profit buffer since time is running out. So these are just the things you need to be aware of when you're taking trades later on in the session and time is running out to the close. At the time it does hit the mid S1, S2 level, As you can see here at the 3:52 p.m. candle close, it is $22.90 bid. So if you did hold on to any runners, any remaining runners, then that would be your exit here, because we're going into the end of the session here with just a few minutes remaining in the session. Okay, so as I stated earlier, this particular video is a shortened video to give you an introduction to this indicator and this trading system. If you would like to see a more expanded uh, video which goes into a lot more detail about the daily key level strategy and other aspects of the daily key levels trading strategy and other aspects of this indicator, please look in the description of this video for the 2 longer SPX session videos and click on those and take a look at those. Also, if you'd like to look at all the other features that the SPX daily key levels indicator has, you can look at the other link in the video, in the description of this video, which is a link to the new features video for the SPX daily key levels indicator, which was just introduced a few months ago. That particular video is split up into chapters. It is a fairly long video, but it is split up into chapters, and you can simply look in the description of that particular features video and go to the particular features that you'd like to look at and simply click on the chapter timestamp for that. Now, if you are interested in purchasing the indicator, we offer the SPX Daily Key Levels V3.0 indicator by itself, and we also offer it as part of an SPX indicator suite. If you are interested, and that suite also includes the ribbon indicator plus one other indicator. If you are interested in either the SPX Daily Key Levels V3.0 indicator by itself or the SPX indicator suite, you can send us an email at daytradinggps@gmail.com to request a promo code, and please specify whether you'd want the promo code just for the SPX Daily Key Levels indicator itself, or if you'd like to also have the promo code for the SPX indicator suite. So send an email to daytradinggps@gmail.com to request a discount promo code, and we will send you one that you can use to get a substantial discount on your purchase. All of our indicators are sold on a one payment for lifetime access basis. That means you're not paying a subscription fee, monthly, quarterly, or yearly. You're just making one payment, and then you have access to the indicator for life. So thank you for taking your time for watching this video today. We'd like to close out the video by showing you some of the user feedback and reviews that we've received from traders who have purchased our daily key levels indicators and used them on a daily basis. So if you're wondering how these indicators are working for people who purchase them and use them, we'd like to show you some of the reviews and feedback that we've received from traders that use them. You can also see all of these reviews by clicking on the links in the description of this video for the SPX Daily Key Levels Indicator, and then you will see all the reviews and feedback that have been left for our Daily Key Levels Indicators. Thank you again for taking your time for watching this video today. We appreciate your support of this channel, and we wish you much prosperity in all your future trading. Okay, so for those of you who might be wondering, well, how is this working for people that have purchased the Daily Key Levels Indicators? You can go to daytradinggps.com and look at the user reviews and feedback. We've just taken some of them here and highlighted parts of them, but we invite you to go to daytradinggps.com and look at the reviews and trader feedback on our various daily key levels indicators, including the SPX daily key levels indicator. Thank you.